Good morning, everyone. Welcome to Windsor Brokers Live Daily Market Outlook for Wednesday, 24th of October, 2012. At the beginning, I would like to apologize for a slight delay and also for yesterday's technical problem. Unfortunately, there was a problem with the program, and unfortunately, the sound, the voice, my voice, you were not hearing, and actually I had all indicators pointing that everything is okay. And on the top, there was a failure in recording part of the session, so unfortunately we were not able to even to place it on the YouTube. Finally, everything has been fixed and solved, and I hope that today we are not going to face any further problems. And not to waste more time, I would like to welcome you all to our today's session, and to start with our today's outlook for the major currencies and the commodities. Euro is still under pressure following yesterday's failure to hold the 130 handle, dipping as low as 129.50, but temporary support was found there with some corrective action seen during the late yesterday and overnight session, approaching again initial barrier at 130.00. Overall bullish tone on euro is still quite intact despite the failure to break above 131.70 and reversal of the lower top at 131.38. Some parameters are still intact, good supports on the downside, keeping the overall bullish structure of 120.41 in place so far. We will see as the near-term structure is quite negative at this point, following yesterday's fresh leg lower and sharp fall below 130.00. Whether we are going to see the major reversal of the larger uptrend, or we're going to see the extension higher. Our technical outlook will give us some more details about this. A similar situation with sterling that remains under pressure after losing important 160 and 159.75 supports, dipping as low as 159.11, testing Fibonacci support. Currently, we are in the technical corrective action with not much prospect seen on the upside unless we see regain of, I would say, minimum 160.65, 161. Dollar yen is consolidating recent gains under 80.00 with the narrow range sideways mode seen between 79.70 and 80.00. Similar with the dollar Swiss that is consolidating yesterday's rally to 93.42, holding above 93 important and psychological support. However, some still negative signals seen on the hourly chart probably might be trigger for a stronger corrective action, but larger picture is still seeing more potential towards the upside. Gold and crude oil remain under heavy pressure as the oil hit a fresh low at 85.67, breaking below the recent congestion base. The recent, we are talking about past 2-3 months from 87.00, 85.67 was low seen so far on the December contract of light sweet crude oil. More pressure still seen towards the downside as some important levels have been lost. From the yellow metal, still consolidates the latest losses. Basically, yesterday's fresh extension has tested 17.03, just ahead of our initial target at 1700, with brief consolidation seen up to 1714 so far. Overall outlook remains firmly bearish for now, and doesn't see much prospect for any more significant corrective action, though overextended conditions might signal some bounce higher, with the approximately 1730 zone seeing capping any stronger moves higher so far. From today's calendar that is quite busy and has a number of important releases, I would like to highlight the first, the most important is the US FOMC meeting and the rate decision of Fed. Basically, the rates are expected to stay unchanged at levels, there's record lows at 0.25%, but Fed is expected to keep buying bonds despite some firmer growth of the U.S. economy signaled by the recent releases of the economic indicators. The Federal Reserve is intent to stick to its bond buying stimulus on today's meeting. Already indicated it would take more than a modest show of economic strength for policymakers to begin taking their foot off the gas. The Fed unveiled the third round of bond purchases last month to try to rev up sluggish economic recovery despite a looming presidential election that some thought might deter action. Analysts now believe that the central bank will wait until at least December to make any changes to its current plans to buy 40 billion of mortgage debt per month. Said at 18:15 GMT is going to be released, and more indicative at this point, and more interesting will be the FOMC statement that comes immediately after the release, where Fed will again confirm and give more details about their decision for bond buying that has already been mentioned. From the Europe, we have series of PMIs to be released today. Started with the Chinese that came in much better than expected, 49.1 compared to 47.9 in the month of September, with the French manufacturing PMI coming along with expectations slightly above 43.5 is the release compared to 43.4 of the forecast for today, and better than the previous month at 42.7, while services PMI from France came at slightly below the forecast, 46.2 compared to 46.9 forecast, and 45, basically better than the previous month release. Still to come in a couple of minutes is the German PMIs. Manufacturing PMI is forecasted at 48.1, better than the previous release of September at 47.4, and the same with services PMI at 50.1 forecast compared to 49.7. Quite optimistic tone is seen on today's forecasts for PMIs in Europe, along with the European one that comes at 2 minutes before 11 o'clock. 2 minutes before 8 o'clock GMT. The time is slightly incorrect at this point, as some calendars give the round figure instead of 7:58 and 7:28. Basically, the German one has already been released, so we're going to take a look. Composite PMI it's 48.1, services PMI 49.3, manufacturing came at quite disappointing 45.7 versus the forecast, as we said, 48.1. So at this point we can say that what I just said, that quite optimistic forecast did not materialize in the release, as the manufacturing German PMI came much below the forecast of 48.1, the release is 45.7. European one is at 46.5 services PMI forecast compared to 46.1 of release of September, and 46.6 for the manufacturing one compared to 46.1 in September. German IFO business climate for October is due at 8 o'clock GMT. Improvement according to today's forecast 101.9 compared to 101.4, with the UK industrial order expectations for October slight improvement, though still in the negative territory, -5 compared to -8 in September. ECB President Mario Draghi is due to speak at 12 o'clock GMT, and then series of data from US, again PMIs for October. Manufacturing PMI is forecasted at 51.5, above the September's release at 51.1. New home sales are expected again to tick higher, 386 units forecasted for today of new sales in the month of September compared to 373,000 of the month of August, and the crude oil inventories are again set for another build up. Unfortunately, it doesn't show in our calendar. 1.7 million barrels increase in the past week is seen on today's consensus compared to build of 2.9 million barrels in the previous week release. Bank of Canada is due to release its monetary policy report at 14:30 with press conference following at 15:15 GMT. And then as said, the federal funds rate release of FOMC decision and the FOMC statement that will give us some more clues about further steps of the U.S. Federal Reserves. And of course, at the end of the day at 20 GMT is the Central Bank of New Zealand is going to release its their rate decision. Forecast is unchanged at 2.5% rate of the New Zealand Central Bank. And we're going to take a look now at the currencies and commodities to see the latest movements and the forecasts for today. I will wait a second until you see the screen. Starting with euro hourly structure remains weak as a brief corrective action of 129.51. Yesterday's fresh low did not show much of the action at 129.95 seen so far, unable to clear initial 130 barrier, and the fresh slide now underway, seeing more threat again towards the downside as a part of the larger down move from 131.38, the recent peak posted on 17th of October 2012. As said, more focus in towards the downside with the immediate supports at 129.50 and approximately 129, currently 30, approximately 129.40. This is the bull trend line connecting 125 and 128.25 lows, and 129.30 is the 61.8 Fibonacci retracement of the entire rally from 128 base to 131.38. Daily, 4-hour structure is maintaining a negative tone as indicators are below their midlines and still pointing lower, as the latest upside failure at 130.00 sees immediate risk on test of 129.51, yesterday's low. From the other side, the strong uptrend of 120.42 low of 24th of July 2012 is still intact. Basically, good base at 128 is the strongest support, along with the 128, 128.30, along with the 200 days moving average, where is also the above this is the main bull trend line of 120.42 at 128.50. So we are seeing a cluster of supports from 128.50 to 128.00, and basically only break below these levels could have more significant impact on the current bullish structure. Otherwise, any reversal above 129 that is seen as a psychological support or a trend line support at 128.50 will still keep bulls in play for possible extension higher towards our upside targets 131.38 and 131.70. As said, 130.00 now acts as a good resistance and so far caps the upside. Any break above this level requires a regain of the Fibonacci 1 at 130.22 is 38.2% retracement, 130.13 the previous lows. So basically, lift above 130.20 may provide some relief. However, in order to turn the focus towards the upside, we need to see a gain of a minimum 130.70. This is the previous high and the peaks of 22nd, 23rd of October consolidation tops with the highest at 130.82. If we see a break above 130.70, then more focus will be seen towards the upside. Until then, still the downside remains favored with the immediate threat at 129.51, 129.40 trendline support that would allow for a stronger reversal of larger 120.42 to 131.70 uptrend. With the sterling, as said in the introduction, the downside pressure continues despite current brief consolidation as the pair extended the losses yesterday to fresh low at 159.11. This basically marks 38.2% retracement of the entire rally from 152.67 low 1st of June to 163.08. Important was loss of supports at 163.00 and 159.75. That also the 55 days moving average that triggered the fresh weakness, and as we mentioned yesterday in our session that you might not have heard, also in the written analysis, 159 was our initial downside target, nearly reached, with some bounce higher seen as a corrective action preceding fresh weakness. At this point we have just take a look at Fibonacci levels. 160 as a round figure and psychological resistance. 160.13 is the Fibonacci 38.2 of the down move from 161.78 down to 159.11, while a break above 160.50, 160.75 would be seen providing temporary relief and averting immediate downside risk. Hourly studies are have gained some momentum, although the MACD is still below the midline, pointing higher. Seems that the current strength is running out of steam on approach to 160. This is similar to Euro, where 130 offers quite good barrier at this point. Sterling faces a strong resistance at 160. Break of which, and I would say more important, 160.50, 160.70 required to turn the near-term focus higher and allow for stronger recovery. However, a larger downtrend of 163.08 remains firmly in play, especially that break below 160 and 159.75 supports triggered the daily indicators to break below their midlines. That is probably going to be a good signal for a further extension lower, and the loss of 159.10, 159.00 to open way towards 158.25. This is the low of 5th of September 2012, as well as 200 days moving average, our next strong support, and I would say next near-term target, unless the pair regains previously mentioned the levels approximately 160.75. That will prevent further slide temporarily. To turn the focus higher and signal stronger recovery, we need to see the break above trendline resistance 161.35 and the previous high at 161.56. Any reversal of any bounce and reversal below these levels would be just seen as corrective action and risking a lower top ahead of fresh extension lower. As said, the negative tone that dominates on the lower time frames, despite some oversold conditions that are now triggering the corrective action, is seen just preceding a fresh weakness and extension lower towards our next downside targets at 158.25, 200 days moving average. And dollar yen still in consolidative mode of 80.00, recent peak sideways movement seen between 79.70 and 80.00, with the price hovering around the 10 and 20 days moving average, basically neutral tone seen currently. For our chart, studies are still a bit toppish at this point, as RSI is slightly below the overbought territory, and the other indicators starting to point lower. RSI is also below the 7 days moving average, and not ruling out some stronger corrective action with the loss of initial 79.70 support, seeing risk towards 79.45 previous high and 79.40, 23.6% retracement. Ideally, any deeper dip should reverse around these levels. However, further extension lower down to 79.00 cannot be ruled out, but definitely the reversal should occur at or above 79.00 in order to maintain the near-term bull. 79 is around figure support, and 38.2% retracement of 77.42 to 80.00 rally, and the only break below 79 would put near-term bulls on hold in favor of stronger recovery. Conversely, any reversal at 79.70 as initial support or 79.50 zone would see the focus still towards the upside, and our next upside targets on clearance of 80.00. Immediate one is 80.09, peak of 5th of July, with more significant 80.65, peak of 25th of June 2012, and the 50% retracement of the yearly slide from 84.17 to 77.12. Dollar Swiss seems to be gaining ground again after a brief correction of 93.42. Yesterday's peak found ground just above 93 psychological support. I think we can see it better on the 4-hour chart. Near-term uptrend remains so far intact with the break above 93.47 that marks 61.8% retracement. This is what we mentioned in our this morning's written reports. Requires a break above 93.47 and the static barrier at 93.70 in order to confirm the bearish action of 92.13 low of 17th of October and shift focus towards significant barriers on the upside. Then 94.00, where is approximately 93.87 is the 200 days moving average, and the double top at 94.36 and 94.30. Since the pair broke and closed above the main bear trend line, and the daily studies are now pointing higher with the momentum already emerging above the 100 center line. It's seen. This is seen as a quite bullish signal at this point, with the prevailing positive tone seen on the lower time frame studies, seeing more potential towards the upside and further recovery, as basically the pair failed to materialize the formation of a double top pattern that was briefly confirmed on a break below 92.37, but failure to clear 92 as a trigger psychological support has resulted in a current bounce that now turning a near-term focus towards the upside and looking for a trigger for a stronger corrective action of the larger downtrend from 99.70 to 92.13 so far. Initially, the 94 zone also offers, along with the 200 days moving average, 23.6 Fibonacci retracement, and break above 94, 94.30 would be a good signal to pick up some stronger recovery, and then open way towards 95 that marks 38.2% Fibonacci retracement. Oil's strong downtrend, as shown on the ADX studies, is still intact following the upside rejection and the strong fall from a 93.50 recent congestion zone, with the bears remaining fully in control. On the daily picture, the indicators are holding in the negative territory, pointing lower, as recent break below the 90 days moving average that was basically limiting the downside in the congestion between 93.60 on the upside and the approximately 90.50 on the downside. With break here and some significant levels at 90.25, 88.94, and the latest range floor at 87.69 now sees much more prospect towards the downside, basically starting the third wave of 100.72 peak of 14th of September. The first one was has ended at 87.69, corrective one capped at 93.50-60 zone, and now fresh third wave is underway. We estimate approximately extension down towards 83 zone as the next downside target, according to a rough estimation of the wave principles. Negative tone dominates also on the lower time frames, although overextended conditions on hourly have already resulted in the brief bounce higher of yesterday's low at 85.67, regaining 87.40 zone so far, with the moving averages on the hourly chart still pointing lower, the big ones 20 and 55 days one, while the 10 days now is starting to point higher and crossing above 20-day moving average. I wouldn't say that we can see much of the corrective action so far of the latest down move from 93.47 to 85.67. 23.6% so far keeps the upside limited, as the RSI is already starting to point lower, along with the momentum that is still in the positive territory, and stochastic is already on the down move. According to the hourly studies, not much to be seen from the corrective action. Anyway, further extension might face 88.34 currently, the 55 days exponential moving average, and 88.65 previous low of 22nd of October and the 38.2% retracement. More interesting, I would say, would be the downside as a brief break below 61.8 Fibonacci retracement of the entire rally from 77.27 to 100.72 on a dip to 85.67. Still sees more potential towards the downside. And as said, approximately 83.60 will be our next target. This is static support low of 10th of October 2012. And finally, yellow metal. In our yesterday's report, I mentioned that 1700 is our next target. We have nearly reached it. 1703 seen so far in late hours of yesterday's U.S. session. A steady downtrend from a fresh yearly high at 1795 in failure to regain 1800 as psychological barrier has resulted in this losses. A break below 55 days moving average at 1713. That was equivalent to the previous low. Now aims towards 1700 psychological support and 1693, 50% retracement of the uplift from 1590 to 1795. As daily indicators now broke below their midlines, more focus is again seen towards the downside and further retracement towards the already mentioned the levels would be the likely scenario. Corrective action faces initial barrier that has been so far tested at 1713 previous low, and then I do apologize, the previous peak of yesterday at 1730 that is so far expected to cap the upside with another stronger resistance 1738, 38.2% retracement along with the descending 55 days exponential moving average. Basically any break higher should be contained so far for now at 1730, 1740 zone in order to keep the current downtrend in play, and the downside target seen at 1700, 1693 as initial. Once with the position with extension down towards 1668, 61.8% retracement, and 1662, the 200 days moving average, not ruled out on extension below 1700. That was all from my side. Please, if you have any questions, you can submit them now. Okay, it seems that we have no questions for today. I would like to thank you all for attending our session. We're back tomorrow morning at the same time at 7 o'clock GMT. Until then, I wish you a nice day and, as we always say, good, profitable and successful trading. Good luck.